virtual study course on tax audit. This is the second study course after last month's study course on company audit. I welcome everyone on behalf of Nasik branch. Just a hint about the course, we'll be taking it from 20th to 24th June, wherein different topics will be circulated. And today we have with us CA V Chitale sir, Central Council member, to guide us on relevant clauses of guidance note on tax audit. I request our branch vice chairman, CA Rakesh Pardeshi, to introduce today's speaker to the audience.
Thank you, Sanjeevan. Welcome everyone for this session. Today we have a speaker, Chandrasekhar Chitale sir with us. Sir is a Central Council member and practicing chartered accountant, senior partner of V Chitale and Company. Sir had been a member of managing committee of Pune branch of the Institute of Chartered Accountants of India during the period 1988-91 and was a chairman of Pune branch for the year 1988-89. Sir had been vice president of Pune Chartered Accountants Society in year 97 to 99. He is a treasurer of the Maratha Chamber Commerce, Industries and Agricultural, and also been a direct tax committee chairman of the said institute for more than a decade. He is nominated on committee for capacity building and by the ASCOHM on cost audit and assurance standard board. Sir had been nominated on export advisory committee and on ethical standard on justified removal of auditors of ICI Central Council. He was nominated on a committee of ICI to present representation on direct tax code 2010. Was a member of group constituted by IFRS implementation committee of the ICI on a compilation of study material. Sir had been contributed draft textbooks which has been adopted as a study material for the intermediate and final curriculum of the ICWAI. He has written several articles in newspaper and periodicals including the Economic Times, Management Accountant, Taxman, Arthamanthan, Sampada and many more. He was awarded first prize of R.T. Doshi Foundation for a best article in a PCS newsletter. Sir had been a lecturer visiting faculty at Gaware College of Commerce and various management institutions. He has delivered several lectures at conferences and meetings of professional and other on topics of taxation, investment, company law, accounting and auditing. Sir has specialized in corporate tax consulting, legal drafting and appellate practice before First Appellate Authority and Income Tax Appellate Tribunal. With this brief introduction, I request Sir to take the charge of session. Thank you.
Well, namaskar. Thank you, Rajesh, and thank you, Tambulwadikar, and all of you, my good friends from Nasik. It's indeed a pleasure to engage a lecture on this particular favorite topic of tax audit. Of course, when it was said I am guide, actually this is a discussion session. Openly we can discuss whatever we want to. We will try to address those issues because in tax, no issue is having conclusion. So maybe at the best we can arrive at the better solution. So this season of tax audit will commence. In some cases it might have commenced. In case of banks, might be some of our friends have concluded the tax audit. However, as far as our institute is concerned, let me state that our direct taxation committee is going to release the tax audit guidance note, a draft of which has been shared. If anybody from the branch is interested in contributing to that guidance note, he may seek that draft from me. He can either inform the branch or inform me and I will share the draft. But now within 1 week or a couple of weeks time, this particular guidance note would be concluded and thereafter it would be released. Coming to the topic allotted for the day, and that is certain issues in tax audit. So let me share the PPT, and with the help of this PPT, we will try to deal with the topic. So issues in tax audit is the subject for the day. Certain issues I have raised. If at all we have some issues, maybe you can raise in chat box, and maybe organizers can ask me. As we are aware that the prerogative of tax audit, unlike other audits, where say in case of cooperative audits, certain GST audit, cost accountants are also doing. In case of trust audit, certain other auditors are doing. But if we consider tax audit, that is a prerogative which is entrusted to the chartered accountants. But it was challenged by certain sections in Supreme Court, and where the Supreme Court has observed that chartered accountants, by reason of their training, have special aptitude in the matter of audits. It is reasonable that they who form a class by themselves should be required to do the audit of accounts of business whose income exceeds 40 lakh rupees and professionals whose income exceeds 10 lakh rupees in any given year. There is no material on record. Indeed, in our view, there cannot be an income tax practitioner has the same expertise as chartered accountants in the matter of accounts. For the same reason, the challenge under Article 19 must fail. And it must be pointed out that these income tax practitioners are still entitled to be authorized representatives of the assessee. So friends, this confidence has been reposed by the apex court of the country in chartered accountants. And by doing a tax audit in an appropriate manner, I think we as a profession of chartered accountants would certainly like to uphold whatever has been held by the Supreme Court. And such seminars would go a long way in achieving this particular mission. So friends, let us try this discussion on this particular topic of tax audit. And I have divided it into 7 different parts: appointment, code of ethics, standard of auditing, and accounting standards. These are the matters at times not seriously dealt with in many of the reports, because when the matter comes up for appeal, when I notice that it is subject to tax audit, there are one or the other things relating to maybe code of ethics, maybe standards on auditing or accounting, they are not followed. And therefore, I wish to first invite attention on some of the issues or some of the shortcomings which flow from this particular facet. And thereafter, we will discuss some significant aspects of 3CA, 3CB, 3CD. I am sure that there are subsequent sessions also where this particular topic will be dealt with by other faculties, and they will cover up in detail those aspects. Firstly, the appointment. As we are aware that as a tax auditor, there is a separate appointment. In case of company, you may be appointed as an auditor. In case of a cooperative society, the annual general meeting may appoint you as an auditor, but that does not automatically mean that you are appointed as an tax auditor. So a separate appointment is required, separate procedure is required to be followed for this particular appointment. Before we move on to the appointment, if the appointment is made, one will have to introspect whether he is eligible to accept the appointment. And there, section 44AB tells that an accountant defined in explanation to section 288 of the Income Tax Act 1961 is eligible to carry out the tax audit. But the definition of accountant in section 288 has undergone substantial change. So accountant means a chartered accountant holding certificate of practice under Chartered Accountants Act. However, if we go on to further read this section 288, this section 288 also lays down certain inclusions, certain exclusions. So those we must be aware. Of course, in case of each audit, we need to examine that whether I am fitting into this particular clause or not. Because if you are not eligible for appointment and then you accept the appointment, there would be a great problem, and that it may lead to disciplinary action against the person accepting audit in contravention of those provisions. So one has to carefully consider this definition of accountant. It says that in case of a company, a person who is ineligible for appointment under section 141 of the Companies Act will also not be able to get the appointment as an auditor. And in this particular case, it is also stated that a relative or an officer of the employee is not able to get the appointment as a company auditor. As a consequence, he will not be a tax auditor of a company. In case of indebtedness, it is prescribed under the Companies Act that if a chartered accountant is indebted to the company of an amount exceeding 5 lakh rupees, then in that case, he would not be eligible to carry out the tax audit. In case of guarantee also, if he has provided guarantee to certain indebtedness, he is ineligible. If he is holding equity or security interest in a company, he is ineligible. If he is having business relationship with an associate, he is ineligible. Of course, in case of indebtedness, although the Companies Act has given leeway of 5 lakh rupees, the Code of Ethics, which we will see subsequently, have this particular upper cap of 1 lakh rupees. So if any chartered accountant is indebted for 2 lakh rupees to any company, in that case, he will be ineligible to accept the appointment, because although the threshold is 5 lakh under Companies Act, that threshold is 1 lakh rupees under our Code of Ethics. Besides this eligibility under Section 288 of the Companies Act, we will also have to consider the other provisions of Section 288, and particularly in case of other than company, Section 288 also has laid down certain restrictions from accepting the appointment. Those also should be carefully seen. There also, in case of partnership, proprietorship, cooperative society, an officer or employee of the company cannot conduct the audit. Any relative of the person who is either owner or a proprietor or partner or director or interested person in this particular assessee, he is not eligible. Then in case of an assessee being a trust institution, then persons referred to in Section 13(3), there are various classes of persons. They are also ineligible from conducting the audit. An individual who is partner or who is in employment of an officer or assessee of the company is ineligible. So there are various negative tests which are given under, if it is company, under Companies Act, if not a company, under Income Tax Act, and in both the cases under Code of Ethics. So before you accept the appointment, please ensure that you are eligible for acceptance of the appointment. Then while considering the appointment, the entity or the office that is appointing us as an auditor should be an appropriate authority having right to make appointment. So in case of company, this particular right of appointment vests with the board of directors of the company. It does not vest with the annual body. So there is no need of annual general meeting resolution, but even board of directors can appoint. In case the board of directors had delegated this authority to the managing director or to any other person in charge of governance, in that case, such a person can make the appointment. In case of a partnership firm, any partner can make the appointment because the agency principle is applicable. Or it would be better if there are working partners, any working partner makes the appointment. If amongst the working partners, they have made bifurcation that who will do what responsibility. So there we have to see a person in charge of accounts, audit, etc. He is making the appointment. In case of proprietorship, it would be the proprietor making the appointment. So all those things need to be seen whether the person who has signed the appointment letter had authority to appoint. Then the question arises whether there should be an appointment letter. In case of organizations like company, where the paraphernalia of staff is available, formal appointment letters are given. But it is noticed that in case of partnership and proprietary, at times, supposing the auditor is consultant, thereafter the audit starts, but formal appointment letter is not given. When appointment letter is not given, even question of issuing acceptance letter also does not arise. But this is not a good practice. Code of Ethics also requires that appointment letter in black and white should be obtained. Of course, whenever we say in black and white in hard copy, now it is also substituted by communication through email or information technology mechanism. So such communication which can be authenticated. So if the email is sent, it is sent from the official email ID of a person making the appointment who has to do something with the company or any other enterprise with which he is related and appointment is made. So such authentic appointment letter should be on record. And it is a better practice that after having received the appointment letter, we also give acceptance letter. In the acceptance letter, we set down the terms of condition that we would expect books of account and other record for the purpose of audit latest by the month of June end or July end. as you consider appropriate. What are the limitations in audit? What record they have to prepare? And if the record is prepared in time, by what time the audit would be over? So generally acceptance letter would also deal with it. So it is healthy practice to have appointment letter and also to give an acceptance letter. Then friends, let us come to certain important provisions of code of ethics at times which are ignored. Firstly, whenever there is change in the office of auditor, maybe in a previous period there was some other tax auditor and subsequently the tax auditor has been changed. Code of ethics has a mandatory condition that you must inform the retiring auditor and seek his no objection certificate. This particular communication has to go by registered AD post. Now, with the advent of information technology era, a concession has been made that even if you send this particular communication by email at the last known address of the previous auditor, in that case, if the particular email has got a facility of giving acknowledgement, that would be considered as a sufficient communication. So such communication should be made to the outgoing auditor and his no objection certificate should be received. Of course, at times, no objection certificate is not received. At that time, the code of ethics say that you wait for a reasonable period, and after lapse of reasonable period, if you do not receive any communication, then you can accept the audit. So the council has laid down guidelines in regard to the same and are appearing in paragraphs 2.14 under the chapter 8 part 1 first schedule of the volume 2 of code of ethics. So those should be seen. At times, under section 142, income tax department also makes appointment of a tax auditor to conduct tax audit. So in this case also it would be a healthy practice if the tax auditor appointed by the income tax department communicates with the statutory auditor, with the tax auditor before he takes up the audit. Of course, here since this office was not held by any other person, there is no need of formal receipt of no objection certificate, but it is a healthy practice just to communicate for them to give the information that you are doing audit on behalf of income tax department. Then under the council guidelines 2008, certain restriction has been placed on the number of audits maximum one can conduct. So maximum number of specified audits at present is 60. So during the financial year 2022-23, a chartered accountant cannot conduct more than 60 audits. If in case of a branch, supposing you are appointed as a branch auditor, or if the company is having 3-4 branches and you are appointed as auditor or 1 or 2 branches, then in that case, each branch is considered as a separate audit. So if you have 3 branches, maybe 1 of bank, 1 of insurance company and 1 of company, it would mean that you have conducted 3 audits and balance 57 is left. But if you are auditor of a bank or of a company which is having 10 branches and you conduct audit for the head office as well as all the 10 branches, then it is not that you have conducted 11 audits, but you have conducted only 1 audit, because assessee is the company which is having several branches. But if on a standalone basis you are appointed as a branch tax auditor, then that would be counted as 1 separate audit. While considering this number of 60, there are certain estimated income schemes, section 44 AD, section 44 ADA, 44 AE, etc., under which you have to report certain minimum income. So if your turnover is up to 2 crore rupees, if you are reporting income up to 8%, or in case of banking transaction up to 6%, then you are spared from the requirement of conducting the audit. However, if income reported is not in conformity with these sections, then in that case, that requires that the assessee should get his accounts audited from a chartered accountant. So whatever audits which are conducted under these sections 44 AD, ADA, etc., in these cases, whatever entities for which the audit has been done will not be counted in this number of 60. Code of ethics also requires this guidance that the auditor doing tax audit should maintain a register of tax audits. And this we are seeing particularly in northern region and in certain parts of southern region, that the chartered accountants are not maintaining this limit of 60. They are also not maintaining a register of tax audit, and there are disciplinary cases against those members, and they find it difficult defending the case. So in right earnest, it is advisable that register of tax audit should be maintained, and also the tax audit should be conducted within the confines of this number of 60 tax audit, excluding tax audits under section 44 AD, ADA or 44 AE. There is one exception to this number in case of a partnership firm. See, as far as this limit is concerned, this limit has been fixed per chartered accountant. Let us assume that there are two chartered accountants who are partners. One is looking after tax matters and the other is looking after, say, GST matters or corporate law matters or corporate audits. In that case, the institute has issued a guidance note that this number per firm would be, if since there are two partners, it would be 120. So if one partner conducts 120 audits, it is permissible because other partner is not conducting any audit, and subject wise they have bifurcation. Say one partner doing tax audits and direct tax matters, other doing indirect taxes and allied work. So as per convenience of the firm, where two partners are there, the limit which is available to both the partners would be available to any one partner, and any one partner can conduct 120 audits. It is also possible that there are A and B as a partner, and B is conducting certain tax audit in his individual capacity. So he's practicing as a proprietor as well. In that case, if he conducts, say, 20 audits in his individual capacity, then out of his quota of 60, 20 are exhausted. So only 40 are left. So this partnership firm of A and B, A will conduct his own 60, and as far as B is concerned, his quota of 40 would be available. So in that case, he can conduct maximum 100 audits and not 120. Supposing this B, besides running a proprietary firm, he is also partner in some other firm, say B and C. And there, on his account, another 25 audits are conducted by the firm B and C. Then out of 60, his quota of 20 audits which he is conducting individually, 25 audits which are conducted by Messrs B and C, the balance remaining would be 15, 60 minus 45. So only 15 additional audits can be conducted by A in the firm A and B, 60 is own and 15 on account of his partner B. Of course, whenever A is conducting more than 60 audits, 80 audits or 100 audits or 120 audits, SQC1, which is the standard on quality control of audits, it requires that the quality should not impair, and then they have given the modus operandi how this particular quality should be maintained and how it should be ensured that this quality is being maintained. So auditor will have to follow this SQC1. Then only he can venture in conducting this additional audits. Then one question arises, if a chartered accountant is an internal auditor, whether he can conduct tax audit. So as you are aware that auditor should be independent. He should not be rendering any services to management in discharging the function as a management. Internal audit is a management function. Therefore, the council has decided that internal auditor of an assessee, whether working with the organization or practicing as a chartered accountant and conducting internal audit of any organization, he will not be eligible to conduct internal audit of the client of which he is internal auditor. Then in respect of audit fees, as a ICAI, audit fees, minimum audit fees cannot be prescribed that, okay, you must accept this much minimum audit fees, because this will be hit by provisions of Monopolies and Restrictive Trade Practices Act, because it is prerogative given to the profession of chartered accountancy to conduct the audit. And if some minimum level of audit fees are prescribed mandatorily, then it becomes a restrictive trade practice. So no mandatory fees have been prescribed, but guidelines have been laid down by Committee for Capacity Building of Members in Practice, and they have recommended, depending upon Class A or Class B city, what can be the minimum level of tax audit fees. And recently revised minimum recommended scale of fees is for Class A cities, it is 40,000 and above, and for Class B cities, it is 30,000 and above. Of course, since these fees are recommendatory, one can charge lower than minimum fees, and it would not be breach of code of ethics or any regulation of ICAI. But in order that all the profession is benefited, if audit fees are maintained at a decent level, then in that case, everybody will be benefited. It is not that the only firm which is charging more is benefited. Maybe there may be some clients not willing to do the audit, but if there are some clients who are willing to pay the fees which you command, in long run, you will see that only good clients are with you, and you are able to make up with whatever fee level you accept in an aggregate. So these are the recommended fees. Now coming to standards on auditing, it needs to be noted that standards on auditing are not applicable only to corporate audits. These are applicable to corporate as well as non-corporate audits. Tax audit, whether you are doing of a company or whether you are doing of a sole proprietorship, partnership, LLP, or cooperative society or any other entity, standards of audit are mandatory in nature in respect of each firm, whether it is small, whether it is medium, whether it is large. So irrespective of category of the firm, standards on auditing are mandatory. Let us see some important standards which are followed in breach. Firstly, audit documentation, section SA 230. Audit documentation is the record of audit procedures performed, relevant audit evidence obtained, and conclusions of the audit auditor reached, working papers, work files, etc. Friends, I had also occasion to sit on disciplinary benches for 3 years, and it was noticed that whenever any case of negligence comes, there are two set of people, set A, set B. As far as you consider set A, these are the chartered accountants. When they are confronted with the charge of negligence, they will explain us in detail how they conducted the audit. They will also say, for say week, we never went home till midnight. We were at client's place. We were doing detailed audit. Even tea, lunch, dinner, everything was at the client's place. So that much sincerely we did the audit. We always discussed with clients whatever the things are there. And then after detailed verification, we have conducted the audit. So 2-3 hours, they will explain how the audit is conducted and how sincere they are. But friends, let me tell you that there is another set of people, set B. They will not talk for 2-3 hours. They will talk for 5-10 minutes. But on a table, they will place 4-5 files. And these are the audit files containing the audit program, who has conducted the audit, what was the work allocation, how the important matters were discussed, when the meetings took place, and the confirmation letters from bank, from traders, from debtors, and everything. So, friends, you will appreciate that the chartered accountants who are in this set B, they easily defend their case and they win the charge against them, and they are held at not negligent. But those who are explaining only orally and they don't have documents at their disposal, they find very difficult defending their case. If on a particular matter, if there are two views and you take one view, you are not negligent, because you have considered various circumstances and you came to the considered opinion that, okay, this is the correct view, and you have documented both the things, and you have also stated why you have taken this view. So if there is error in judgment, the error in judgment is not negligence. But if you don't do the audit, then it is negligence. If you don't perform all the steps and you don't have documents to justify what you have done, that would be negligence. So at the cost of repetition, let me earnestly request you, and even if I could make appreciate this single point that audit documentation is a must. Audit not documented is not done. That is the message that we should carry home. And in respect of each audit, right since appointment letter till final audit report, we should contain everything in the audit file. This is an electronic era. So maybe books of account are in electronics. Maybe you have popular software of Tally or others. And they are susceptible to number of changes without anybody being noticed. Because in manual, you can know that something is erased, something is rubbed. But in computers, you don't know whether any change was made now or subsequently. So even in case of audit file, if you take printout of a final trial balance, final accounts, certain important accounts, and you keep them on your file, that would be justifying your case, because after audit, if some changes are made in the accounts, you will not be able to know whether the changes were made beforehand, or before the audit, or changes were made after the audit was concluded. Only this type of documents would save you. Not only you accept this final trial balance or financial statements or some of the accounts, but let them be signed by the company secretary or the accountant or the partner or the proprietor, so that there would be authenticity to those documents. So friends, please don't be shy in accepting these particular documents, copies thereof. Don't be under the impression that the partners or the proprietors will feel that you are disbelieving them. You can tell that it is not question of disbelief, but it is part of our ICAI code, standards on auditing requirements, and therefore I am compelled to take it, and this is a standard auditing practice. So SA 230 compliance is not optional, it is mandatory for all the firms, even including small proprietary firm audits. So please be mindful as far as this audit documentation is concerned, and keep an habit of writing and maintaining this particular audit files. They will help you in long run, because the atmosphere has become litigious, and there are so many agencies like NAFRA, SEBI, even Income Tax Department. They are finding shortcomings in tax audit report, and they are referring those cases to ICAI for appropriate action. And when the number of cases increased and no formal action was taken in the form of disciplinary cases, CBDT was unhappy, so they had this dialogue with the institute, and then institute has constituted Tax Audit Quality Review Board, TAQRB. So whatever such complaints are made, they are sent to the TAQRB. On its own, TAQRB also reviews number of audit reports, and thereafter, if anything is found that which is not in compliance with auditing standards, accounting standards, as far as Income Tax Act is concerned with the Act, appropriate action is initiated by Tax Audit Quality Review Board. And whenever such unpleasant event occurs in your case, it is only audit file and audit documentation that will save you. Even it is possible that maybe we have seen that there is dispute between the partners, between the two brothers, between the company management on one hand, on the shareholders on the other hand. And because both of them are respectable people, instead of filing suit against the other director or the other partner, they find it convenient to file disciplinary case against such chartered accountant. And at that time, even small error comes out before the disciplinary committee, and the chartered accountant finds themselves in an awkward position. So please be mindful of SA 230 and ensure that audit documentation is carried out. Then SA 580 is written representation. As you are aware that SA 580 requires the auditor to obtain written representation on certain matters. And in case of these matters, generally there are three types of matters where evidence is available. Secondly, where evidence is available but not readily producible. I will explain this case. And in third case, one has to rely on management representation. So in each case, auditors will be protected in a different manner. It is necessary to take the representation letter. Let me cite certain examples. Say payments made to the persons under section 40A2B, commonly we called as associated enterprises. So these are the persons where maybe in case of company, the director, the dominant shareholders, or in case of partnership firm, partners are interested. it may be their relatives, brother, sister, lineal ascendant, descendant. There may be certain enterprises where this brother, sister, or anybody else who is associated is partner, proprietor, or having substantial interest, or is a director. Unless you know who are the associated enterprises from the directors or from the partners, how you are going to proceed with the audit in case of company, in case of true and fair view, and in case of tax audit, how you will know? Supposing there is an assessee and is a firm and there is one partner, and that partner has got 5 brothers, and maybe 3 brothers are living in the city in which you stay and 2 brothers are abroad or maybe at some different place. In that case, you may not know by personal acquaintance that, okay, these are the 3 brothers. So you should take their names. And while giving names, supposing name of one brother is missed and his enterprise is missed and there are transactions, then you will be protected because you can always represent that name of this brother or enterprise as associated enterprise was not given to us. So how do we know? Because you are not an investigator to find out who are the associated enterprises, but whosoever is associate and furnished by information is furnished by the client, you can rely on it. But in case of certain other informations like the companies in which directors are interested, maybe one director is interested in 5 companies, and in the representation letter they give only name of 4 companies, and you rely on it and do the audit, then you will be guilty because this particular piece of evidence was verifiable with the help of certain record available under Companies Act, namely the register of directors' interest. So that you should have seen. You should not have blindly relied on the representation letter. So the standard also says that written representation will protect you where the information is not available, but where information is alternatively available from some other source, then you will not be protected. So likewise, who is the member having substantial interest in a company? You need not rely only on representation letter. You can see the shareholders register, the equity shareholders register, and whosoever is having more than 10 or 20%, you know that he is the person who is interested, and accordingly you can conduct the audit. And in third case is like in case of say work in progress. To what percentage there is work in progress? In case of popularly say construction industry, they say our construction project is 60% complete. So how without engineering skills a chartered accountant would know it is 60% complete? So in that case, representation letter would be of immense use. Of course, the directors, even if they are engineers, the chartered accountant cannot rely simply on directors stating that the project is 60% complete. There has to be backing of certificate from some competent person like an architect, an RCC engineer, or an engineer, construction engineer. And if they certify that it is 60% complete, give a certificate, and based on that certificate, if management represents that percentage of completion, that would be reliable. Again, the standard says that besides this particular certificate, you should look at it with skepticism and put it to test. Now, supposing there is budget of 50 crore rupees in respect of a particular project, and the management has and the engineer have certified that it is 60% complete. And from the books of account, you realize that there is expenditure of 25 crore when the budget was 50 crore, or there is expenditure of 35 crore when the budget was 50 crore. So in that case, again, you have to put to test, you have to counter ask them that when the budget is 50 crore, 60% of the expenditure comes to 30 crore, you have spent only 25 crores, then how it is 60% complete? Or you have spent already 35 crores, then how do you say that it is 60% complete? So this question should be asked, and thereafter the reply should be taken, and accordingly, if you are satisfied, you can rely on that management representation. Otherwise, you can express your reservation as well. But friends, in this case, representation letter is a must. While we discuss forward, we will see in case of some other issues also. Without representation letter, you will very find difficult in protecting the case of negligence against you. Then SS 700. SS 700 is a mandatory. It is mandatory for small partnership firms of chartered accountants, medium firms, and large firms. There is no exception. SS 700 has to be followed. But in many tax audit report, SS 700 is not followed. Now, what is SS 700? SS 700 is forming an opinion and reporting on financial statements. So after completing the audit, auditor has to issue report on financial statements. So what the report should contain, how the conclusion should be drawn is all discussed in SA 700. As far as this report is concerned, the pro forma of report is given. It says that in the report, you have to state management responsibility for the financial statements and what management has selected accounting policies, etc. So for tax audits, let us bifurcate tax audits into two components. Component number one, the corporate enterprises and other entities for which the audit is mandatory under any other law for the time being in force. So maybe for cooperative society under Maharashtra Cooperative Societies Act, it is mandatory. For charitable trust under Maharashtra Public Charitable Trust Act, it is compulsory. So that is one category of assessee, and the other is to whom audit is not mandatory under any law for the time being in force. So take example of partnership firm or a proprietorship where audit is not compulsory. So where audit is not compulsory, the tax auditor is issuing two reports. One is that the underlying financial statements on which the tax audit report is furnished, those are true and fair. That is number one. And secondly, the particulars which are furnished in Form 3CD are true and correct. In case of companies and other assessees to whom the audit is mandatory under any other law for the time being in force, that audit report is issued under the said law. So the Companies Act, the audit report is issued. So in that report, the true and fair view of accounts is examined and a report is given. So there, this particular compliance with SA 700 is already available in that audit report. But in case of particulars which are true and correct, which are compiled by the management and handed over to the auditor, that recital is not available. So companies, so the entities for which you are doing audit of true and fair view of financial statements, you will have to include these two paragraphs in SA 700, that management responsibility for financial statement. The auditor report should have a section heading responsibility of the management for financial statement. The report of the auditor should use the term which is appropriate in respect of legal framework. So it may be board of directors, it may be trustees, whatever. And the reporting on financial statement should show that the auditor's report should include preparation of financial statement as per relevant financial reporting framework, and for such internal controls as per the discretion of the management as deemed necessary are in existence. Evaluation of the ability of the entity to continue as a going concern and whether the basis on which the going concern the accounts are prepared is the management decision. And what is the responsibility of auditor? The auditor should state that he has to prescribe the objective of the auditor are to acquire reasonable assurance as to whether the statements are altogether free from material misstatement. And auditor's report should also include prescribe the reasonable assurance refers to the high level of assurance. However, it isn't the guarantee that the audit conducted as per SA would always be identified as material misstatements. Mention that the misstatements could arise from error or fraud or either. State the material error or fraud are considered and give the definition of materiality. So these are the various aspects of SA 700 which are dealt with. So to conclude, there are two things. One, which you are conducting audit of an entity for which audit is not mandatory. You have to state that the preparation of accounts, selection of accounting policy, etc. is the responsibility of management, and responsibility of the auditor is to express an opinion by following generally accepted auditing standards. And in respect of both the category of entities, one has to consider that particulars furnished in Form 3CD are the responsibility of the assessee, and they have furnished it and we have audited it. So these statements should be given in your audit report. Then only your audit report is SA 700 compliant. Now, supposing there is some other mistake in the tax audit report, and thereafter the disciplinary action is taken, and even if it is found that supposing there was no such mistake, the auditor has been appropriately, audit has been appropriately conducted and reported. But still, if supposing these paragraphs are not there, the disciplinary committee will come to the conclusion that SS 700 does not been followed. And if any standard on auditing is not followed, then in that case, the auditor is held guilty of negligence. Then the question arises, the auditor, after having uploaded a tax audit report, can he revise the tax audit report, whether there is sanction to this particular revision under the standards on auditing? As a rule, once the tax audit report, it should not be revised. But then a tax audit report which has not been approved by the assessee can be revised. Subsequently, supposing the tax audit report is approved by the assessee, it cannot be revised unless the assessee concurs. And for this revision, there may be two categories of reason. One is error in accounts and assessee wants to correct it, which was unnoticed. And secondly, error in audit report, which the auditor notices and he needs to correct it. So, as far as this correction is concerned or revised audit report is concerned, there is no bar in revising the audit report. But if the audit report is not approved by the assessee, the auditor can revise it. If it is approved by the assessee, then with the concurrence of the assessee, it can be revised. As far as the practical aspect is concerned, utility does not have any restriction on revision of audit report. It is accepting revised audit report, and this particular revision can be made on a number of occasions. It is not that only twice you can revise or thrice you can revise, but the more you revise, the more serious problem may arise in your case and in case of assessee. Now, as far as this revised audit is concerned, revised audit report, there is a guidance note on revision in the audit report. So this guidance note should be followed. What the guidance note says? Guidance note says that whenever you are issuing a revised tax audit report, the tax audit report should conspicuously state that this is a revised tax audit report. So reader, without any difficulty, should know that what he is reading is a revised tax audit report. That is condition number one. Secondly, one has to state what were the errors or mistakes either in accounts or in the report. These have been revised. So these errors need to be pointed out and these can be revised. And lastly, how these errors have been dealt with. So when you mention these things, you can revise your audit report. So revision, no bar, but guidance note on revision and audit report has to be followed. Now friends, let us come to accounting standards, and I will deal with only those accounting standards which are mandatory in all cases and which are at times we find when matter comes for appeal, these are not complied. Many a times there is a complaint that these accounting standards are not applicable. Therefore, there is no point in looking at it. Friends, let us try to understand in case of corporate assessees, in case of company assessees, accounting standards are mandatory. So it goes without saying that company assessees must follow accounting standards. Then in case of non-corporate assessees, the institute has bifurcated all assessees into 3 levels. The bifurcation I will give only on popular terms, which is based on turnover, because other bifurcations are also there. I'm not dealing with them. I'm dealing only on important bifurcations. For level 1, if turnover of the entity, say partnership firm, if the turnover exceeds 50 crore rupees immediately preceding previous accounting year, or borrowings exceed 10 crore rupees at any point of time during the immediately preceding accounting year, then in that case it is level 1 entity. Then level 2 entities, turnover between 1 crore and 50 crore in last accounting year, and borrowing between 1 crore and 10 crore at any time during last accounting year. If this is the condition, then it is level 2 enterprise. And if it is not level 1, not level 2, then all residuary are level 3 enterprises. So why these levels? If you say that these levels are based on your turnover or your size. So for level 1 entities, almost all the accounting standards are mandatory. For level 2 and level 3, certain concessions are given in complying with accounting standards. So with those concessions, say related party transaction, level 3 enterprise need not report it. Or in case of employee benefits, in case of level 3 enterprises, they need not to take actuarial valuation in case of gratuity. So certain concessions are given for level 2 and level 3 enterprises. So accordingly, one has to see that these accounting standards are complied with. Although the parent law governing the entity is not talking anything about those accounting standards, still, if the accounting standards are not followed, then the auditor is duty bound to report non-compliance with any accounting standard which is mandatory as per the chart laid down by the ICAI for level 1, level 2 and level 3 enterprises. Now let us come to certain compliances which are found missing. AS1 is disclosure of accounting policy. This is mandatory at all levels. This standard says that while preparation and presentation of financial statements, what accounting policies are followed, and these must be stated. It is seen that in case of certain companies, they say auditors accounting policies, and then they give one paper which is annexed to the balance sheet and say these are the accounting standards of the auditor. But mind you, this is not accounting standard of auditor. These are accounting standards by the client who has followed it in preparation and presentation. In some cases, these accounting standards are stated in audit report, which is also totally incorrect, because this disclosure of accounting policies has to be in accounts and not in audit report. So it should be annexure to the accounts and not annexure to the auditor's report, or a separate page saying that auditor's accounting policy. These are incorrect practices. Again, in case of accounting policies, at times we find that 3-4 accounting policies are stated. This is also incorrect. In respect of each major item, what is the accounting policy needs to be stated. Now, supposing company has made investment of substantial amount or significant amount. In that case, temporarily they might have invested. It is appearing at the balance sheet date or not appearing. But accounting policy leading to accounting of investment must be stated. It is not that you just state about income, expenses or other things and not about accounting policy leading to investments. In case of current assets, people state about stock, but they don't state about debtors and advances. Actually, the accounting policy about debtors and advances or other current assets is debtors considered doubtful, provision is made, and those which are considered irrecoverable are written off. So this accounting policy needs to be stated in accounts. So 2 responsibilities on auditor. One is A, accounting policies are stated as a part of financial statements. That is number 1. And B, all significant items of income, expenses, assets and liabilities, they are covered by one or the other accounting policy. And of course, while you are conducting the audit, you must also ensure that whatever stated in the accounting policy is in fact followed. If it is not followed, then also qualification will be there. Then valuation of inventories. In case of trading and manufacturing enterprises, inventories are there. So there has to be compliance with this AS2 valuation of inventories. Now, in case of valuation of inventories, popularly what is stated that stock is valued at cost or market price, whichever is lower. This is the standard remark which is found. And people believe that they have complied with AS2. But this is non-compliance. This does not mean that you have complied with. Because if you read the accounting standard, it does not employ the term market value. It says net realizable value. So inventory should be valued at lower of cost and net realizable value. There also it is found that the wording used is inventories are valued at cost, lower of cost or net realizable value. The word or is incorrect. It is lower of cost and net realizable value. This is the correct representation. Secondly, whenever you are talking of cost, you must also state what are the components of cost. So cost includes direct materials, direct labor, direct overheads, and other associated expenses which are attributable to the inventory. So these things need to be stated. Valuation. A remark is put in accounts that the inventory is taken, valued and certified by the management. And we believe that auditor cannot look at the valuation. This is also a misconception. Valuation may be made by the management, but it is duty of the auditor to examine whether that valuation has been correctly made or incorrectly. And if it is incorrect, then it will affect the true and fair view of the inventory and of the profit for the year, of the balance sheet for the year, or the assets for the year. In one case, it was noticed that royalty was being paid, substantial amount of royalty, and the amount of royalty was factored in the cost of raw materials. When the auditor inquired, the royalty was being paid on sale of the products. And supposing the royalty paid was 20 crore on the items sold, and purchases were say 20,000 kilograms, out of which 2,000 kilogram raw material was in stock. So the company tried to factor on proportionate basis 20 crore by 20,000 kg and divided by 2,000 kg in stock, and appropriated the amount of this brand valuation or royalty in the cost of raw materials. So there the auditor has to understand costing, that in case of valuation of inventory, there is a matching principle. This royalty is paid on sales, it is not paid on purchases. So it does not, the purchase value of raw materials does not include component of royalty. Therefore, royalty cannot form part of closing stock of raw material value. So all these aspects need to be examined. Although the management has done the valuation, it is auditor's responsibility to examine that valuation, and wherever he finds it incorrect, he will have to qualify the report accordingly. Again, in case of manufacturing concerns, the inventory is required to be bifurcated into inventory of raw materials, inventory of work in progress, inventory of finished goods. Besides raw materials, work in progress and finished goods, it is possible that the entity is trading in certain goods. So those goods which are purchased for sale, they may be identical with the goods which are manufactured, but both stock cannot be said in fixed finished goods, but finished goods should be shown separately, and the units, the stock of units traded should be shown separately. So this needs to be ensured. Then employee benefit. In case of employee benefit, generally it is found that provision for gratuity is not made. It is not made either whatever be the tenure of the company, or maybe company is having 30 employees and company is existing, or the partnership is existing for 3 years. So in that case, at the end of 3rd year, when the balance sheet is prepared, gratuity provision is not made. And the reasoning given is, we are yet to complete 5 years. Since 5 years are not complete, no employee is eligible for gratuity. So no provision is made. And this contention is accepted by the auditor. But please appreciate, this is incorrect. Because even after completion of 5 years, the employee is not eligible to get the gratuity. He will get gratuity only at the time of retirement, not in between. So gratuity is matching time cost with the period of service. So even if he has completed 3 years of service, gratuity does accrue. As a going concern, enterprise will complete 5 years, it will complete 10 years, employee will also continue, and therefore on some day gratuity will have to be paid. Supposing if the total, generally it is 15 days wages per annum is the gratuity, or it is say half the month's remuneration. So supposing if the total wage bill is 120 crores, or let us say 12 crore rupees, and in that case, after end of 3 years, if you have to make provision, by rule of thumb, it would be provision 1 month remuneration would be 1 crore. So 50 lakh would be the provision for gratuity. Of course, I am not on exact certain allowances do not qualify for gratuity, etc. That is different. We are assuming that 1 crore entire this particular amount of salary is eligible for gratuity. So 50 lakh would be the provision. So if you consider this theory that okay, till first 5 years gratuity will not accrue, and only after completion of 5 years will accrue. So suddenly for 5 years burden cannot be borne by 1 year. That is not the matching principle. So it is at most necessary that gratuity provision has to be there. If gratuity provision is not made, then in that case, the true and fair view also will be affected. So disclosure, not only one should stop at saying that no provision for gratuity is made, but depending upon if the amount is substantial, significant, then one can also report the impact on profit as well as the impact on liability, which is not appearing in the balance sheet. As far as valuation is concerned, in case of level 3 enterprises, valuation of gratuity on actuarial basis is not mandatory. Then borrowing costs. Borrowing costs are also required to be identified with the qualifying asset. When I say qualifying asset, it is not property, plant or equipment or fixed asset. Qualifying asset can be stock. Take example of construction industry, where more than 1 year's time is required to complete a project. Let us say that a particular project requires 18 months. In that case, in year 1, it will not be complete. It may be complete in year 2 or year 3, depending upon when the project has started. So if for the purpose of that project, there is any borrowing or the borrowing can be attributed to that project, then in that case, it is necessary that the borrowing cost has to be identified with the cost of project or the work in progress. Because this particular borrowing cost standard is applicable to qualifying asset, and qualifying assets include those assets which take more than 1 year to complete, which are meant for realization or resale. In respect of assets also, this is applicable. So in preparing accounts, it is mandatory that this borrowing cost accounting standard is followed. In case of income tax also, ICDS require that this borrowing cost standard is followed for the purpose of computation of income. So there is no exception that for small enterprises, if they don't follow, it is okay. There is no exception. Everybody has to follow. So there is difference between accounting standard for borrowing cost and ICDS. In case of accounting standard, directly attributable interest or borrowing cost is capitalized. Otherwise, it is not capitalized. In case of ICDS, you take starting date of the project, end date of the project, and for the entire period, asset the interest is capitalized. What is the difference? Take example of a construction project which would conclude within 18 months, and there is certain borrowing. Project started after 6 months. The project could not function for say 6 months, maybe because of corona or because of legal problem, and then it got completed. So instead of originally planned 18 months, because of abnormal circumstances, it extended to 24 months. In case of accounts, only normal borrowing cost for 18 months will be capitalized. Those abnormal, that period of 6 months, the cost of interest for those 6 months will not be capitalized. It will be expensed out. But in case of income tax, you have to just take 2 dates, starting date, end date, and the entire interest between starting date and end date will be capitalized. So for accounts, it will be 18 months interest that can be capitalized, and for income tax, it will be 24 months interest that will be capitalized. So that may be the difference, but the underlying point is, in accounts, you have to consider provision, and as far as ICDS is concerned, you can consider the deviation in accounts and make the adjustment. Accounting for taxes on income, you are aware that there are timing differences and permanent differences. For timing differences, deferred tax provision is required to be made. For permanent differences, there is no adjustment. What is permanent difference? Supposing cash payment is made or payment otherwise than by account pay, check, etc. of 10 crore rupees or say 10 lakh rupees is made. In that case, that entire expenditure gets disallowed, and there is no room that it gets allowed by doing some formula. So there is a permanent difference of tax because of disallowance of 10 lakh rupees. But then in case of 43B, supposing 10 lakh rupees taxes are outstanding on say 30th of September, in that case, it will be disallowed for the year in which it is incurred. But supposing in December they are paid, so in the subsequent year that 10 lakh rupees allowance you will get. So there is a temporary disallowance for 1 year. In next year it will get allowed. So this is called temporary difference, and this is considered as a tax asset. And this tax asset is required to be provided because current year's income tax has been artificially increased and subsequent years income tax will be artificially reduced. So when you prepare this tax asset, at both the years, tax is shown at a normal figure. And please try to understand, accounting for taxes on income is mandatory accounting standard at all levels. So if it is not complied with by proprietary or by partnership, it is necessary that the auditor draws attention to this particular non-compliance, and in appropriate cases where the true and fair view is affected, where the liability or the asset is not recognized, the qualification will follow. So friends, these were the preliminary parts relating to A, the appointment letter, then code of ethics, standards on auditing and accounting standards. I have not dealt with them exhaustively, but certain issues, certain non-compliances, which I noticed during my stint as a disciplinary committee member, I have covered. Anybody on the screen, if they are managing, if there are any queries up to now, you can tell. If there are no queries, then we will proceed to other parts of the tax audit, namely 44AB, 3CA, 3CB and 3CD. So are there any queries up to now? Or anybody can unmute and ask me. So I presume that there are no queries, and let me proceed. As far as section 44AB is concerned, as you are aware, that the tax audit is applicable if the turnover exceeds of a business exceeds 1 crore rupees, but there is a proviso that aggregate of all amounts received, sales, turnover, etc., including, if not exceeding 5%, is by way of otherwise than account pay check or otherwise than through banking channels. If this happens, then there is an extended limit of 10 crore rupees. And similarly, in case of all payments, if payments otherwise than banking channels are up to 5%, then one can have additional threshold of up to 10 crore rupees. So it is not necessary that you will be in for tax audit even if your turnover exceeds 1 crore rupees. But then when you consider this particular exemption, what one has to carefully consider is, supposing your sales turnover is 2 crore rupees and you have made purchases of say 12 lakh rupees in cash. Apparently one may feel that with sales turnover of say 3 crores and cash sales being 12 lakhs, apparently one feels that this criteria of 5% is breached. Because as compared to 3 crores, let us say 22 lakhs, as compared to 3 crores, 15 lakh would be the 5%. But the section requires all receipts, not only the receipts by way of sales. So supposing besides sales, there is borrowing of 1 crore rupees during the year and which came through banking channels. So in this year, total receipts will not be 3 crore, they will be 4 crore rupees, and there is additional infusion of capital, say 1 crore rupees. So total receipts would be 3 plus 1 plus 1, 5 crore, and 5% of 5 crore is 25 lakhs. You have received 22 lakhs sale proceeds by cash. Therefore, you are within elbow room of 55%. Similarly, in case of purchases, you have to consider all payments, even if you have purchased plant, machinery, or any other thing, or there is withdrawal from capital, then you have to aggregate everything and then calculate 5% of the aggregate. So you are not required to focus only on profit and loss account, but also consider the receipts and payments from balance sheet side to come to the conclusion that whether there is breach of 5% or not. And after considering that there is no breach of 5%, then in that case, tax audit is not applicable. The question arises that can I get the tax audit carried out voluntarily? The answer is no. You cannot get the tax audit carried out voluntarily because tax audit is mandatory under section 44AB if you are covered by those particular provisions. If you are not covered by those provisions, then in that case, tax audit is not required to be done. Because section 44AB says every person, then certain conditions are laid down, and which says that, I will read, carrying on business shall, if his total sales, turnover, gross receipts, as the case may be in business, exceed or exceeds 1 crore rupees in any previous year, then the proviso says about 10 crore, and then there are other provisions, and at the end it said, get his accounts audited for the previous year. So now let us assume that you have done sales turnover of 3 crore rupees, you have received 22 lakh rupees in cash, and 1 crore rupees bank borrowing, 1 crore rupees capital addition. So your cash receipts are within 5%. If your cash receipts are within 5%, you are not liable for tax audit. And this is important because particularly if the company or the enterprise meets with loss, then they feel that, okay, if there is loss, we will compulsorily get the tax audit done and we will file audit report before September. But it is not so. Under 44AB, if the tax audit is not applicable to you, due date of 30th September or 1 month ahead of filing of return is not available to you, and the due date will be July. So this is very significant distinction between this 5% exemption and otherwise. Secondly, as far as this tax audit is concerned, when you are covered by this particular provision that your sales are within 5% by non-banking channels, purchases are within 5% of non-banking channels, then in that case, it is section 44AB throws you out from the coverage. And when you are out of 44AB, you cannot get the tax audit done under section 44AB. Voluntarily, you may get it done. But since tax audit is not applicable, your due date will be different. So this aspect at times people don't realize. They feel that if my turnover is say 7 crore in case of a software company, where generally all receipts are by banking channels, and they feel that, okay, 30th September is the due date. If there is a loss, we can file before 30th September. We'll get the tax audit done. But this is not correct. So these things will have to be considered. Again, one more aspect is missed in this case. Supposing your turnover is 3 crore rupees and you have reported 50 lakh rupees capital gain. So you consider 3 crore 50 lakh as the aggregate cash receipts, but that is also incorrect, because supposing you have purchased shares for 1 crore, you have sold them for 1 crore 50 lakhs, and 50 lakh rupees is the profit reported in your profit and loss statement, and 1 crore you have knocked off from investment. So in this case, your receipts, including turnover, etc., are 3 crores plus 1 crore 50 lakhs and not 3 crores plus 50 lakhs. So it will be 4 crore 50 lakhs. So distinction has to be made between, in case of capital receipt, between capital gain and the sales value of the capital asset. So this aspect also should be considered. Thirdly, if supposing in a given case, the turnover is 3 crore and the cash sales are say 16 lakh rupees, and there is breach by 1 lakh rupees in respect of this particular proviso. And if the partnership firm is smart and they realize before March, and if supposing they introduce 1 crore rupees capital from a partner and maybe in 3rd, 4th April they withdraw it, technically their receipts would be 4 crore and this 16 lakh cash sales receipt would be within 5%. So number of things as far as this 5% and other things are concerned.
Sir, your voice is not audible, sir. I request all the members to be patient. I think there is a loss of connection from host. So we are contacting the sir, and sir will be right back in 5 minutes. Please be patient. Thank you.
आणि मग आमचं लग्न झालं काय?
प्रॉब्लम हो गया।
Sir will join shortly.
Am I audible?
Yes, sir.
I'm not able to share the screen. There are some problems. From which screen we left, so that I can repeat from that rather quickly.
Sir, from that fashion designing.
So okay. So I think maybe half an hour ago.
Yes, sir. Yes, sir.
So let me. So I think most of the part has been left. I see. So what I'll do, I'll not share the screen now because it will take too much of time. I'll just go on from my. So I will now touch upon important points, and maybe if on some other day we can look at those aspects. So I hope that I continue to be audible.
Yes, sir, you're audible.
Yeah.
And what we will do is we will share presentation amongst the member later on.
Yes. So what I will do, I will share the important aspects. I'll touch upon, not the entire thing, and then we will, in question and answer, if there is anything further, we can. So first important point is about UDIN and updating of UDIN. There was much panic when the UDIN was not updated, and then I explained that as far as section 44AB and this rule 6G is concerned, one has to appreciate that it gives responsibility to the auditor or to the client or the assessor that he should obtain the audit report from the assessee, from the auditor, and upload it on the income tax website or furnish it to the income tax department. There is no mention of UDIN either in section 44AB or rule 6G. So assuming that the UDIN is not updated, I don't see any adverse consequence for the client, because he has complied with section 44AB, read with rule 6G. Of course, one may feel that I should comply with all the requirements. So this UDIN requirement was by way of a notification, and you can try to update it. Still, if it doesn't get updated, I don't see any possibility that there is adverse consequence to the client. Then coming to form as per rules versus schema, the guidance note has taken a stand that we will go as per rules. And as far as physical versus uploaded tax audit report, people believe that, okay, if the tax audit report is uploaded, that is end of the thing, and that is the tax audit report. But in guidance note, the view taken is, as far as tax audit report is concerned, the earlier theory continues, and you have to issue hard copy tax audit report, and that will be the tax audit report. As far as uploading is concerned, uploading is mechanism for the purpose of communication or furnishing of tax audit report. It is not the furnishing of tax audit report by the auditor. This is furnishing by the client when he accepts it, although the uploading is to be done by the chartered accountant. Then coming to 3CA, as we are aware that as far as qualification or any reservation is concerned, this is required to be stated by the auditor. If it relates to a particular item, it is stated under each item, but the item does not provide adequate space for the purpose of mentioning this qualification. Therefore, a recommendation is made in form guidance note that in paragraph 3 of tax audit report and paragraph 5 of in form 3CA and paragraph 5 in 3CB, you should mention it. In 3CA, you should mention that particulars are provided by the assessee. You have just verified them. And in 3CB, about the balance sheet and financial statements, that these are provided by the assessee based on the accounting policies selected by him, and accordingly you have audited them. And thereafter, whatever qualifications you want to state, you can state in form 3CA. In 3CB also, one has to follow all accounting standards, auditing standards, as we discussed earlier. But attention is drawn to one more aspect, and that is technical guide on financial statements of non-corporate entities issued by Accounting Standards Board. As you know, in case of company, the format of accounts is given, but in case of non-corporate assessees, such format was not available. So this aspect we deliberated at Accounting Standards Board meeting, and we have come out with this technical guide. So this particular format is available in PDF format as well as in Excel. So you can download from ASB website and you can furnish it to the clients so that accounts are available in this particular uniform format. Going forward, this format can be made mandatory by the ICAI, and by the time bankers and other stakeholders will be habitual to this format. Then coming to rule 3CD, clause 8, we have already discussed that in case of company, you have to select third proviso to section 44AB, under which the audit is conducted. Then 8A is a new clause. It asks whether the assessee has opted for concessional tax rate. So all others go on mute. All others on mute. So as far as concessional tax regime is concerned, maybe last year, if any entity has opted this concessional tax regime, the underlying form would be available. Last year's ITR would be available, in which you can find out that concessional tax regime is opted for. But if the assessee is going to opt for this year, then management representation letter would be necessary. Then clause 10 asks about business carried on by the assessee. There at times people reproduce from articles, memorandum, GST registration. The principle is that it is not the article, memorandum or GST registration. The question asks what business has been carried out during the year. So you have to just focus what business is carried out. If supposing it is not in memorandum, maybe you can take care while giving company audit report. If not in GST return, you can enlighten him that obtain say amendment to GST registration. But as far as reporting is concerned, reporting will be of the business actually carried out during the year, and then compare it with the prior period and report. Then clause number 11 is about books of account. There, along with books of account, two more things are there. One is whether it is maintained on computer or not. That is not responded by many assessees, so that also is required to be stated. And where the accounts are maintained on cloud, in that case, a view is taken that where they can be accessed, such location should be maintained. So generally, it would be registered office or administrative office. And in case of accounts are maintained at branches also, then names of the branches should be mentioned. Of course, if the common server is at head office, then the location of branches need not be mentioned. In case of clause 11, it asks various relevant documents mentioned, examined. All the documents are not mentioned, only few documents are mentioned. So it is recommended all the documents which go on to have preliminary entry, all those documents should be mentioned in clause 11. Then the most significant thing I was coming to is ICDS. So clause 13 requires you to report on ICDS, what ICDS followed, what adjustments, etc. Now, let us try to understand the chronology. First, the accounts are prepared. Thereafter, the audit is conducted. Then the computation is made wherein ICDS policies are available. But in section 44 AB and rule 6G, auditor is expected to examine books of account. And if you read each ICDS, preamble of each ICDS starts that income computation and disclosure standards are applicable for computation of income, and they are not applicable for maintaining books of account. So while doing audit, you will not be able to know what ICDS policies are followed and where is the deviation. Therefore, in this case, it is absolutely necessary that you must obtain management representation letter. This letter will enclose the computation, and the computation also will state the ICDS policies which are followed. And based on that, you can make comment, you can reply clause 13. But besides replying clause 13 in form 3CA at para 3 and form 3CB at para 5, you must also mention that for the purpose of replying to form clause 13, you have relied on management representation letter because this particular information does not emanate from accounts. So if you do not mention it, then there will be a problem, because again, it is possible that whatever representation is made to you, assessee may not file the return accordingly, he may file some other figures, and then you may be questioned. So you will be protected only if you have this management representation letter. Then one other important clause is clause 17, which asks that if the immovable property is sold at a price below ready reckoner value, there are 2-3 observations. One is it talks of land, building, or both. So it does not talk of leasehold. To my mind, therefore, you need not report on leasehold. Again, if the fair market value is lower than ready reckoner value, then adjustment is not made, but the question does not talk of fair market value. So you have to just report what the ready reckoner value and transaction value if the ready reckoner value exceeds the transaction value. Then in case of depreciation, 2 new adjustments are in this year, that if you are opting for concessional tax regime, then maybe carried forward depreciation to the extent of depreciation under section 32(1)(2)(a), additional depreciation should be weeded out. and balance should be mentioned. And as far as goodwill is concerned, now for goodwill depreciation is not available. So if intangible assets block includes goodwill, you will have to calculate goodwill depreciation on a standalone basis and report the amount of depreciation after this. Then amount of deduction inadmissible under section 14A. So here there is a new additional explanation that if you have earned income which is exempt from tax or likely to earn income which is exempt from tax, therefore even if during the year, supposing there is agricultural land or there is investment in say RBI bonds, and the income may be received after 5 years, or agricultural income during the year there may not be income, still reporting of expenses under section 14A is necessary, because earlier the stand was if there is no income then there is no need of reporting. This particular aspect has been taken care of by explanation. Then question about deemed dividend has been asked, whether the assessee has received any amount in the nature of dividend referred to in section 222E, yes or no. Here it would be difficult to answer the question unless you have balance sheet of that other company, and that too on the date on which the advance was received. So maybe while reporting, if any advance is received from a company, you will have to state that, okay, balance sheet of that company on the date of receipt of advance is not available. So it would be difficult to answer. Otherwise, because as far as 222 is concerned, if the company is loss making and it makes advance, this particular provision is not applicable. In clause 18, the information asked is about Central Excise Act, whether the audit is carried out. In another section, Central Excise Senvat credit question has been asked, and a stand is taken in guidance note that since the word goods and services tax or input credit are not available in the rules, we need not reply it, although they are available in the schema. Similarly, in case of service tax audit, it won't be there because service tax has been dispensed with. And lastly, two more questions. That is section clause number 30C and clause number 44. In clause number 30C, they have asked information about impermissible transactions, and if there is any impermissible transaction, the details, amount, etc. And in case of 44, information about GST. No notification was issued, number 5 of 2020, and it said that these two clauses are kept on a hold till 31st March 2022. What is meaning of 31st March 2022? Whether it is the financial year 21-22 or it is the reporting period ended 31st March 2022. So there are two views, because if it is financial year, then for the assessment year 22-23, the current reports, it will not include these two clauses. And when we started drafting this particular guidance note, these particular clauses, the boxes for answer were not opening. So there was a belief that these clauses are not applicable. But subsequently, last 8-10 days, these boxes have started opening. So again, we asked the CBDT, earlier also we asked, but no official answer has been received. But informally, we are informed that now this year we have to report on both these clauses. As far as GST is concerned, although it is cumbersome, one can answer those clauses because the factual information has been asked, and the guidance will come in guidance note as to what expenses are to be included. But as far as class 30C is concerned, related to impermissible transactions, as far as those transactions are concerned, it will not be possible to respond, for the simple reason that if you look at any other question as far as this particular guidance note is concerned, those questions are based on facts. Wherever, say, unreasonable component under section 48(2) is disallowed, but the question does not ask what is unreasonable component. It asks list of transactions. So what transactions are entered, what payments are made to entities under section 48(2)(b). But here, in case of impermissible transaction, it would be opinion of the auditor that this particular transaction or set of transaction is impermissible. Now, in Form 3C and 3CB, auditor is reporting that whatever is reported in Form 3CD is true and correct. So question 2, clause 30C or answer will be an opinion. So opinion cannot be correct. It may be appropriate to the person giving that opinion. Some other person may not like that answer, or he may have a different interpretation. So it is possible that some disclaimer will have to be put as far as this particular question is concerned. We have made representation on these two clauses, clause 30C and clause 44, that 30C, because it solicits opinion, it should not be included, and 44, because the time for annual return of GST is not over, it would be difficult to respond. So both these clauses should continue to be kept on hold and maybe ultimately omitted. Till today, there has not been any response. But then, while responding to clause 30C, one will have to be skeptical and also put a reservation in form 3C and 3CB. So what the wording of those reservations should be and what answer should be to clause 30C, that the guidance note is going to give some information. So maybe we can follow that particular guidance, so that once guidance is followed, then one cannot be held guilty of negligence. And also, if across the country similar wordings are used, even assessing officer may not ask much questions, because same is the experience as far as 48(3) clause is concerned. We are answering right since 1984 that the checks, whether they are account pay or not, checks are not available, so we are not able to answer. So maybe, although they have put this particular questions, it is very difficult to come to conclusion that this is an impermissible transaction. So guidance should be available through guidance note, and care has to be taken to also put disclaimer in main audit report. So these were the main issues. Of course, there was technological disruption, and I also did not realize that the connection has failed because of rains, or I don't know what it is. But then it got reconnected. I also got telephone calls informing this particular thing. So if there are any questions that audience wants to ask, maybe I will try to respond them. And this PPT will talk about other aspects. If there are still issues, maybe the managing committee can, or the mail can be sent to me, and I will try to respond to those issues. Thank you for the patient hearing, and thank you for inviting me, and sorry for the inconvenience.
Members, you can ask your questions, or you can put it in a chat box so that we can convey it to sir.
Whatever is asked in chat box till now, you can read, so that I will answer. One question came about GST. I'll just check. I'm not able to read here.
Rakesh sir, there is one question. Can you read the question for the sir? Sir is unable to read from the chat box, please.
Yes, I am also looking for that, but that is not visible.
Now 27A, there is a question I am able to read that, sir, do we need to report GST availed utilized credit GST, etc.? That is input tax credit in clause number 27A. Now here, this is the classic example of variation between the utility and the rules. As far as this form which has been notified, the question number 27, clause 27A reads, A, amount of central value added tax credit availed or utilized during the previous year, and the treatment in the profit and loss account, and treatment of outstanding central value added tax. So today also this central value added tax, some of the commodities are under excise duty, and the question does not ask anything about GST. In guidance note, a view has been taken that ultimately what is law? Law is contained in Act and rules. This particular form is product of rules. So rules do not require reporting of GST. So by amending a schema and using the word input tax credit, you cannot amend the law. law has to be amended as per procedure. So view taken is there is no need of reporting GST tax or utilized in form this clause 27A. However, if anybody reports, then we are not considering that it is would be a misconduct or non-compliance. If it is informed, fine. Another question is about turnover 7 crore. All receipts and payments is in bank. However, profit is declared less than 8%. Whether the tax audit is applicable. As you are aware that this estimated income scheme is applicable under section 44 AD. And as far as section 44 AD is concerned, if the turnover exceeds 2 crore rupees, provisions of section 44 AD are inapplicable. So if all receipts and payments are through banking channels, turnover is 7 crore. Section 44 AB is not applicable. Section 44 AD is also not applicable. So in effect, tax audit is not applicable. So even if whether the turnover is about 8%, 6% or below it. So these are the 2 questions which are in chat box. If there are any other questions, you can put in chat box or ask, or maybe you can mail it to the branch and I'll respond.
Yes, sir.
Yes.
There is one more question, sir. Can
Yes.
voluntary tax audit be done?
So voluntary tax audit can be done. You can furnish the report. But in case of voluntary tax audit, your due dates, etc., will not be altered. So supposing you have met with a loss, you do not file by July. By getting this voluntary tax audit done in the month of August, and if you upload the return, loss cannot be carried forward. Or if there is a penalty and fee for delays, they will attract. So voluntary tax audit report department will welcome, but the concessions available for tax audit will not be available qua due date or qua any other thing.
Okay, sir. One more question is there. Which
Yes.
provision is precedence? 44 AB or AD?
Which provision is?
Precedence.
No, I don't understand the meaning. Which provision is?
Anant sir, can you? Ananta sir.
Sir, which section will be applicable for first for calculation of tax audit limit, 44 AB or 44 AD?
Both sections are applicable. If your turnover exceeds 1 crore rupees, tax audit is applicable. I'm talking of business. And if your turnover is up to 10 crore rupees, then if there is breach of 5% limit for your aggregate payments and aggregate receipts, then you are spared from tax audit. If any of these conditions are not met, that is your turnover is up to 10 crore rupees, say 9 crore rupees, but you have 6% receipts or 6% payments otherwise than banking channels, then also tax audit is applicable. Of course, if your turnover is 11 crore, 12 crore, tax audit is applicable. And all these tax audits are applicable under section 44 AB. Now coming to section 44 AD, section 44 AD gives you option to opt for estimated income scheme. And they say that, okay, if you're opting for that scheme, or it is not actually option, it is mandate. So if your turnover is up to 2 crore rupees, your minimum income reporting should be 8% or 6% of your turnover. If you declare any income below that particular limit and your income is taxable, then in that case, you have to comply with the provisions relating to tax audit. So assuming that your turnover is 1.5 crore rupees, and because you are reporting income below particular limit, there is a breach of 44 AD. So the audit would be under section 44 AD. In other cases, it would be under 44 AB. Of course, the distinction will matter only for the purpose of calculating that limit of 60 tax audits. And whether it is under 44 AD breach or that that will be known when you are opting for the option given in those various clauses, under which clause the tax audit is applicable. Hello? Huh? नाही मी जरा सेमिनार मध्ये
Sir, can I ask directly?
Yes.
Sir, in case of, for example, turnover is about within 2 CR, and if it is a loss making.
Yes.
So is it tax? Does the tax audit provision will attract under 44 AD or something?
See what happens for breach of 44 AD and applicability of tax audit. Two conditions are there. One is you have reported income below 6 or 8%. You are reporting loss, so they are below 6 or 8%. But assuming that if it is a partnership and they are only reporting loss, in that case, the income doesn't exceed the threshold. So
Correct.
that second condition is not met. So in that case, tax audit under section 44 AD will not be applicable. But because your turnover exceeds 1 crore, under 44 AB, tax audit will be applicable.
Oh, okay. Fine, sir. But thank you.
Good evening, sir.
Good evening.
Sir, if we opting of 44 section 44 AD is optional, na? If we are opting out of 44 AD, then audit is applicable, na?
44 AD is not optional. 44 AD is mandatory. Mandatory in a sense, if your turnover is say 1 crore 50 lakhs, and you are reporting income of 5 lakh rupees, which is less than 6%, then you have to get your accounts audited under section 44 AB. But if you are reporting income of say 20 lakhs, in that case your turnover is 1 crore 50 lakhs, your income is 20 lakhs, so automatically you have opted for section 44 AD because your turnover is income is more than 8%. In that case, tax audit will not be applicable. So provisions of section 44 AD as well as 44 ADA are mandatory. If you do not want to observe those minimum limits, then you have to get the accounts subject to tax audit.
Okay. Thank you.
Thank you.
Sir, in the last question, under which clause this tax audit will be applicable?
Which that last
Yeah,
question?
correct,
It
sir.
will be 44 AB turnover, breach of turnover under A, clause A.
Clause A. Okay. Supposingly the turnover was below 1 CR, there is no question of audit.
Then there is no question of audit.
Fine, sir. Thank you.
Question. In case of a salaried, hello. So
Yes.
may I go ahead? Yeah, in case of a salaried individual earning salary of about 60 lakh rupees per annum,
Yes.
and he did some F&O transactions
Yes.
where the turnover comes to around 15 lakh rupees and incurred a loss of 7 lakh rupees in that.
Yes.
And he doesn't want to show 8% of that 15 lakhs as income. So tax audit would be compulsory in that case, right?
That would be applicable because his income is exceeding the maximum limit, not liable to
Right.
tax. And now they will have to compulsory done. Up till now they were saying that okay, forget about loss, doesn't matter. But now that annual information statement contains everything, so if he doesn't get that tax audit done, he will be in problem.
Right.
Any other question? And maybe through branch, you can also think of having have some 5-10 tax experts and prepare a standard management representation letter, etc., so that everybody can use it. Because cases of disciplinary nature and against tax audit are now on an increase, what we are noticing.
Okay, sir.
Because
We will do that.
yeah, because income tax department is Now, in faceless hearing, etc., they don't have much work. So they are focusing on even small non-compliances, small queries.
Sir, can I ask a question?
Yes.
So, can you brief us currently what are the questions or the disciplinary actions are throwing? The reasons means in terms of non-disclosure or non-compliance by the chartered accountants, so that we can be quite aware which all areas.
This generally what happens in case of insufficient, wherever there is addition to the income, and that is not flowing from tax audit report, like supposing in case of these transactions of dividend or various other matters, queries are coming to from income tax department, and all are not necessarily resulting into disciplinary, because supposing in case of most these errors are in case of clause under which the tax audit is applicable. So if it is a company, people are talking clause A. So appropriate clause is third proviso to this particular question. So in this case, although the income tax department is reporting, they are not suggesting any issuance of discipline, etc. But hereafter they said that we will be reporting now. This maybe this month or next month we will receive working up to last month, and then tax audit quality review board is going to publish these common errors. So once when we receive this data, it will be known. Up till now, whatever information they have supplied, not much has resulted into disciplinary action, but non-reporting of payment standard section 48(2), or maybe serious non-compliance of TDS provisions. So these were a couple of aspects where this disciplinary actions were initiated.
Right, sir. Thank you. Sir, can I ask?
Yes.
Yeah. So under that 269 SS, 269 ST. So with respect to that clause, suppose that loan is converted into equity. So
technically, it will have to be reported payment otherwise than account pay check, etc. Technically, it will have to be reported only if the penalty is initiated. One can defend that ultimately the object of this particular clause is to unearth unaccounted money, etc. So when it is converted, technically there is breach of 2690, but it will not attract penalty, and there are case laws associated with it.
So we should report that.
It has to be reported.
Okay. Thank you.
Any other issue? And maybe by 15th of July, there will be tax audit guidance note available. So maybe many queries would be addressed with that. One more aspect, incidentally, which one has to deal with it. While uploading income tax returns, what is happening, like we don't take management representation letter. While uploading income tax return, chartered accountants are not taking letter from the client that, okay, this is the return that you upload. In this case, what happens? Supposing there is some concealment or under-reporting or misreporting of income emerges. When the assessee inquired, they say that, okay, I was not aware of this fact. What return was uploaded by chartered accountant, I don't know. So don't hold me guilty. And in that case, chartered accountants can be punished. There are clauses and penalty may attract. So it is advisable that each chartered accountant takes in writing from the client that this is the return that I have given you, and you upload it. So you are acting as a postman, and not that you are computing that income and sending. Even if you compute, you should give it to the client and take his NOC that, okay, you have correctly computed it. Because it is possible that he may have some income, he may not report it, and simply he may give a statement that I informed to the CA, but he did not report it. So in that case, there will be a problem. So such representation letter also should be taken for uploading the return of income, ITR. So should we close? If there are no queries, we can conclude.
Yes, sir. So with this, we will move to final part of this session. I thank CV sir on behalf of Nasik branch for accepting our invitation and giving such a knowledgeful lecture and good presentation. I thank you, sir. Thank you very much. I also thank all the participants for their patient hearing. Thank you all. Thank you very much. We will be joining once again tomorrow. So till then, goodbye. Thank you. Thank you very much.
Thank you.